Hello everybody, welcome to the Forex market research video, and this is the first video in the series of Forex market research. And what I will do here, I will do different Forex market researches and I will share it with you. And today I want to analyze the average size of the swing and average number of bars within the swing. And the first pair for this is GBP Canadian. Well, what I want to know is what is the average number of bars of the swing and what is the average size of the swing. Of course, it is subjective to the algorithm of what you use, and we will find some most common features, something that happens most often. Okay, what I will do, I calculated this thing, I created this thing. So this is the pound Canadian, this is the time frame, very simple. And here is the first algorithm that I'm going to use, is the find extreme within the period of bars. So this is the 5 period, 10 period, 15, 20 and 25. So what I will do, I will calculate the highest highs between of the last 5 bars, the lowest low of the last 5 bars, and I will calculate what is the average size of the swing it produces in pips, and I will type it here. And also I will divide the next swing by the previous one to find the ratio between them, and this will give me some clues if changing the number of bars leads to changing the size of the swing. If I suppose that at some point changing the number of bars does not affect the size of the swing, so it makes no difference if you use, let's say, 100 pips and 100 bars algorithm or 120 bars, for example. But it is not yet it was not yet proved by my scientific research, and in this market research I will do it. So this video will be only about GBP Canadian, and next video will be about some other pair, for example euro dollar or whatever, and I will shoot one video for one pair, and we will analyze them, how they go, and maybe we will come to some conclusions, maybe we will draw some conclusions and make some discoveries, or maybe we'll just waste our time. You will waste it watching the video and I will waste it doing that stuff. Okay, but you never know until you do it. You first need to try. Okay, so what I did, I created a special indicator that I call application 9. I call all my indicators applications. And what it does, it calculates the number of swings in pipsage. So it says that it is 1600 pips, 16,000, no, it says it is 10,657 pips and 6 decimals. So if we measure that from here to here, it will be the same. So you see that? 16 something blah blah blah. Okay, and it also shows how many bars we have. So if you measure it from here to here, so you have 51 bar. The first number is the 51 bar. Okay, well, let's start. I set my indicator, I go here, depth method is true, and the first period is 5. I will analyze the last 20,000 bars. Okay, and what do we have? We have 527.8 is the average size of swing. 527.8. So what it tells me that if I use the highest high between 5 bars or lowest low between 5 bars, the average size of the swing is 527. So if I base some trading based on that, I can set the take profit at this size, or if I have a swing started already, let's say we have it this way, this way, this way, this way, this way, and the correction started, I know that 527 is somewhere average, and I can set the selling order somewhere at this average size, and it should be executed somewhere at that range. So there are plenty of these things, and after executing this, I know that the average size is 527. Then it means I can set my take profit at 527 or something of that kind. And basically we know that impulses are larger than corrections. Yes, so of course the impulse is greater and correction is smaller, and we know that the typical relation between the impulse and correction is 50%. The most typical correction is 50%, so we can calculate the average correction based on that. So if they both give us a number of 527 and the relation between them is 2 to 1, we can also calculate the average impulse size and average correction size. And let's create some formula. Yes, average impulse size and average correction size. I just creating these ideas on the go. So if we have this average size between the two, so this will be average impulse size, and this will be average correction size. Okay, so now let's do it this way. I know that an impulse average impulse size is twice more than a correction size. So let me visualize that. So if I have this line from here to here, and this would be a correction size, and these two will be my impulse size. Impulse, correction. Yes? Okay. But what the average says, the average distance is the middle of them. So it is 527, 527, because it tells them they are equal. If you add 527 to 527 and then you divide by 2, you will have that 527. So we have a 527, 8 here, and we have a 527 here. Here we have x, and here we have 2x. So how can I convert that into a formula that will calculate me what is the x and what is the 2x? Obviously I am to find x. Total size is the 3x. Yes, it is 3x, and half of that size is 527. So 3x divided by 2 is 527, 8. Yes, this means that 3x equals 527 multiplied to, oh, I'm a stupid man, of course it is 527 527. Oh man. So the x equals this 527 multiplied by 2 divided 3. Okay, let's calculate this. So the x formula equals 527, or this, multiplied by 2 and divided 3. Okay, so this will be the formula of x. So the x is here in this column, and here we have 2x. This was funny. Okay, divided by 2, only to multiply it by 2 then. Okay, now we know the formula. We need multiply this by 2 and then divide by 3. Okay, so this equals this multiplied by 2 and then divided by 3. So this is our x, and let the x be of this format. So the average correction size is 351, and the average impulse size equals this multiplied by 2. Okay, now we have it very, very correct. And 700 is the average impulse size, 300 is the average correction size. Oh, perfect. And this is amazing. Okay, now we have it this way. So I will copy, Control C, then I go Control V. It looks to me it is not that way. Oh yes, sorry. So I have to go here, Control V. Yes, it should be that. So I just stretch that to the downside. Okay, we will know the average impulse size and average correction size based on our proposition, or based on our thing, the phenomena that the correction is almost always, not always, but typical average correction is 50%. 50% of an impulse. Of course, there are corrections that are straight to, there are corrections that are deeper, but on average they are 50%, and it is the most common phenomenon to have a 50% correction rather than 3-2, or rather than something else. Of course, when we have this kind of trend, the corrections are small when we have very powerful trend, but this happens rarely. And when we have kind of sideways, the corrections are deep. So this, if this one is an impulse, the correction is almost 100%. Yes. In majority of cases, we have something in the middle that looks this way, something like that, and then we go to the downside. So we in Forex markets, we're mostly channeling. We don't have that exact horizontal, we don't have that exact trending. 70% of time we're channeling to the upside slightly, to the downside slightly. So 50% correction is something that is very, very corresponding to that. It is something that reflects the okay, it reflects the reality. Let us go switch to 4 hour, and we will have our number, and it is 219.1. And you see the average impulse and average correction is calculated in PIPSage. Let's go switching to 100, and we have 103.7. 103.7. if you use this algorithm of 5 period, 30 minute gives us 60.3. It gives us 60.3. Then we go to 15 minute, it gives us 41.1. 41.1. Okay, then if we go to 5 minute, it gives us 21.6. 21.6. So we know the average impulse on 4 hour, we know the average correction on 4 hour. It gives you enormous advantage. So using this algorithm of 5 period bars, you will find a trend, maybe this one, yes, and you know that your average correction should stop at 146 pips. So you set an order somewhere here, and you know that you should take your profit at 229. So you know where to set your take profit, and of course your invalidation will be here. This is the zone to execute that. Your stop loss should be here. So you risk this to generate this, and it looks like a great idea. Looks like the great strategy, having 2 to 1, and you should be at least 50% correct. I suppose you should be at least 50% correct. If we find some patterns here, the pattern is something that repeats again and again and again, maybe in correlations. If we find some correlation here, and it will be very interesting. Very interesting. So there are so many data to be analyzed. So this average impulse, average correction, pipsage, and how they are related to one each other. Oh, guys, I'm having my head just blowing. Let me switch to the second algorithm, and it will be 10 period. Yes, the simple market research may lead to such discoveries. Okay, in 5 minutes we have 31.5, 31.5. Okay, and this is what you should pay attention to. We have 5 period extreme high, yeah, and we have 10 period extreme. With 5 period extreme we have 21 pips average pip size, and with 10 period we have 31 pips. The algorithm is twice greater, yes, but the difference between them is not twice greater, it is only 1.46 times greater. You see that? This means that the relation between them, the size of this swings based on this algorithm and that algorithm, is 46% difference. So I hope you understand that. And it gives me a hypothesis that if we go higher and higher and higher, this number will become smaller and smaller and smaller. So I'm thinking of that. It should become smaller and smaller and smaller. And at some point we will find some algorithm, not the algorithm, we will come to some point where the algorithm doesn't matter. What is your swing? Because it will produce the same swings. Okay, this was 5 minutes. Then 15 minutes, 58.6. 58.6. Okay, 1.43. Look at this precise 1.4, 1.4, 58.6. Then we go to 30 minutes. 86.6. 86.6. Oh man. The ratio between the algorithms, regardless of the time frame, it stays the same. So what it tells me, I will analyze it a bit later. Okay, let's go to 1 hour. 145.6. 145.6. Oh, it's unbelievable. 1.4 or something. Okay, 316.2. 316. 144 again. And let's go to daily. It is 793.3. 793.3. Sorry. Okay, 1.5. I know that daily and 4 hour they simply have not that many bars. My first starting date, if I go here on daily, is only August 2007. It's not 2007. So let me go back. Let me refresh it. Go home. 1999. So if we have 20 years back. The history is 20 years back. So if we divide them by 365, okay, we need to also delete this. Okay, it shouldn't be 365. I know that each year has 52 weeks, and every week is, come on, 52 weeks, and every week is 5 working days. So we have 260. Okay, so 20 years divided by 260. So how many bars No, it's not that. How can I calculate? Multiply 20 years multiplied to 60. So total bar 5,000 bars or less. It is not that so many bars. Not that many bars. So you think it was not calculating correct? Yes, I think it is the same. So 874.4 on daily. It gives different calculation. So let me go to 4 hour. Let me go home. Why doesn't it home? It should go home deeper. Let me reload the indicator. I'll just reinitialize that. And this 316.2. It goes 316.2. Well, here we had a more or less precise calculation. So what if we go to hourly? $145.6. Hourly starts a bit earlier. Okay, now it started. Yes, it starts from here because this is the bar. Okay, 2015. It looks okay. 145.6, and we have what? 145.6. Okay, I think the daily was the only one that was misleading because of that data. I'll switch to 5-period algorithm, and we will recalculate daily. Others are very much okay. 594.6. 594.6. Other bars were calculated okay. So 147. 147. Okay, looks okay. Now let's switch to what? Let us switch to 20 period, 15 period. 15 period algorithm. Why did I start from pound Canadian? Why didn't I start from euro dollar? Okay, let's go to 15 minute. Okay, so what we have on daily? Okay, this is, what is this number? 1040 and 8. 1040.8. I will type it this way. 1040.8. 1.19. The difference becomes smaller. So the difference between these two is 47%. The difference between these two is only 19%. Okay, so it may give me some food for thinking. Then let's go to 4 hour. And what we have for 4 hour is this. It is 391.4. 391.4. The difference between them is 1.24. It is also smaller, and it is also somewhere around 1.2. Okay. Okay. Then let's go here. Now what is this? 1 hour. So 1 hour says the 176.9. 176.9. Okay, and look at this difference. What is amazing is that these numbers are somewhat the same. 1.2, 1.19, 1.2, something of that. Of course, we have some statistical deviation, but the fact is that the correlation between them is the same. regardless of the time frame. So this is kind of pattern here. It is a kind of pattern here. So now we should analyze how we can turn this pattern into profits. It is useless to have a pattern to know something about the market if you don't turn it into profits then. Okay, we'll go to 30 minutes and it is 107.8. 107.8, 1.24 as well. And we'll go here. 15 minutes says 71.1, 71.1, and then we go here and it says 5 minutes says 38.9, 38.9. Okay, 1.23, 1.22, 21, 24, 21, 24, and 19. Of course, daily has less data, less bars. The period is the same, but bars, less bars. Okay, let's continue. So what we'll do, we'll switch to 20 period. And the 20 period algorithm says this. It says 44.5 on 5 minute, 44.5 on 5 minute is 1.14, 44.5. Then we'll go to 15 minute. It gives 83.9, 83.9, 1.18. Okay, then we switch to 30 minute. It is 124.5, 122.5. Yes, it is 22.5. So it is 1.14. We'll switch to 1 hour. It is 2052. It is 2052 this way, 1.16. Okay, then we switch to 4 hour. It is 439 and 6, 439, 6. So we have 1.12, and let's switch to daily. What do we have? It is 1239.6. 1239.6. Daily has the greatest deviation, I suppose, because it has the smallest number of bars. Okay, so what it tells me? It tells me that somewhere around 1.14, 1.14 plus or minus some fractions, 1.14, we have the ratio of that, 1.14. Okay, based on this algorithm. So let me change the color of this. I'll go here, I'll go and set this to no, I didn't want to change the color of this. And I also want the borders should be different. Format cells, I suppose. Oh, no, it is the border. We should have all the borders, and we should have none, outline, and inside. Should have inside and outline. So I just don't see if we have them all. We have none, outline, and inside. Okay. Oh, perfect. I'll go to format that, copy the format, and I'll go to apply it here. Okay, and I will format here, and I will apply it here this way. Okay, so I have some blocks, separated blocks. Nice. Let's go back to our market research, and we start from daily, and this time the algorithm will be the 25, and it should produce the smallest difference between all the algorithms. So it is 13, 70 and 9, 13, 70 and 9, and it is 1.11. okay, then we go to 4 hour, and we have 49.97, 199.7, and it gives 1.14. okay, then we go to 1 hour, and it is 243.6, 1.19. okay, I suppose that it should become smaller, but it becomes sometimes larger. Okay, so my hypothesis may become false, may turn into false. Okay, 134.9, 34.9, 134.9, 1.10. Then we should go to 15 minute. It is 96.9, 96.9, 96.9. So it is 1:15, and let's go to 5 minute. It is 50.6, 50.6. okay, so what do we have is this. Well, okay. And now let's create a separate spreadsheet. This will be the time-based algorithms, and now we will switch into price-based algorithms. So what it is, it should be price-based. What it should be, I will copy that, of course, copy, and I will paste it here. And so what do we have? Here we will have the number of pips of the algorithm, and here it will be the average number of bars that the average swing takes. And with this we have it inverse. So guys, what we have here is slightly different, because if you imagine you have the bars, yes, they are your bars. So for an impulse you have smaller number of bars, but for correction you have greater number of bars. You see, although the distance here, from here to here, you traveled very fast, but from here to here you traveled very small. All impulses in time are twice shorter than corrections. Typically they are twice shorter than corrections, or they are equal. On some markets they are equal, and sometimes they are twice shorter. Of course there is a correlation between them, but I suppose they should be equal to one each other. And although you travel the distance here during the 1, 2, 3, 4, 5, 7 bars, and you travel here, the distance is twice less, but you have the same number of bars. And that's why the average number of bars and average correction should be slightly different. So it equals this, and it equals this. And now you will see what I mean. So I'll substitute that for arrow. Oh, what I have. Maybe I need different color. let me place the different color of white. Okay, I'll go format here, and I'll format here, and then I will go and format this as well. So this time I have blocks. Okay, we will calculate the number of bars here, and I will set the average pips here. So what will be those pipsages? I will delete this stuff. What will be those pipsages? First and foremost, we should base them on this information. So 594, 879, 140, 20, and 130. Okay, what I see is this 900, 600. Okay, it should be 600 pips. Then we should taste 900 pips. Then we should try 1000 pips. Then we should give it 1000. Okay, we should give it 1020 and 1030. Okay, wonderful. So what I will do, I will simply copy this, copy, and then we'll go and paste it here. Okay, let this be 200 pips, let this be 300 pips, let this be 400 pips, and let this be 450 pips, and let this be 500 pips. This one is 100 pips, 150, yes, this one 180, let it be this is 200, and this is 250. This one is 60 pips, okay, this one is 90 pips, this one is 100 pips, this one is 120 pips, and this one is 130. This one is 40 pips, this one is 60 pips, 70 pips, and this one is 80 pips, and this one is 96. Okay, so let it be 100 pips. Okay, if we switch it here, so this one is 20 pips, 30 pips, 40 pips, 45, and 50. Okay, so what is the pips based reversals? It is very, very simple. Let me format that, place it here. It is very, very simple idea. So imagine that you have a swing moving to the upside, and then price starts moving to the downside, and when it is the price size is this range of 600 pips, for example, then the swing is fixed. Yes, so this is the minimum of that. If it is less than that, then it is not fixed, and this impulse to the upside continues until you get something that is more than 600 pips or equals to 600 pips, and then you draw it. So all the movements inside that are smaller than 600 pips, maybe this and this, all these movements are ignored. So this is the pips by algorithm. Okay, 600 pips for daily. We'll switch it to daily. We now go to set the indicator, and we'll disable this depth method, and we'll use pips reversal, and this time we use 600 pips. So how do we know the 600? We should type it this way. Yes, the pips reversal is that 600.1 .0. Okay, so what we have is 21 bars on average. It is 21 bars. Let us see this 21 bars. If we have 900 pips reversal, it should be 900 0. Then we have 49 bars swings. 49 bar swings. Okay, 2 times greater, 233. If we have 100, okay, pips, then it is 60. $60 bars. This shouldn't be that. 60 bars. Okay. And so let me also turn it this way. 1,200 pips. 1,200 pips. Pips and 0. It gives us 87 bars. 87 bars and 103,000 pips. 103,000 pips. Sorry, 1,300 pips gives us 115 bars. As we see, the time correlation between the algorithms is not that, at least I don't see that pattern here. It was the greatest, then it becomes smaller, and then it is greatest here, smaller here, then greater here, then smaller here. I don't see a pattern here. Okay, but what we need to do, we have time projection for an impulse, and we have average correction for this. For example, you know it that the average swing, if you use this algorithm, let's say 5-period algorithm, is average correction. So how can you use that? Your average correction should go to 396. Should go to 396. And you know that if you use 396 algorithm, yes, 396 algorithm, we don't have it here, then it should take you a number of bars, and you know when it should happen. It should happen after 5 bars, yes, for example. Okay, we have 600, we have wrong algorithms. It should detect the correction, yes. So we have wrong algorithms, guys. Sorry. Let's recalculate that. The algorithm should detect corrections, and we know that our average corrections are this. We don't need impulses, we don't need average distance, average swing. We should have the smallest. It should detect the correction and show us what is the correction. So let me copy this and let me paste it here, and I will simply paste the numbers like this, and I will change them. Okay, let me round these numbers, or maybe we should not round them. Nothing bad about that. Precise numbers. I don't think it makes any difference if you calculate 396 or if you calculate 400 pips. The only difference is that we save our time in this video, because we'll take our time retyping them. Okay, 396.4. So let's examine this. What if we use every turn as 396.4 as a turning algorithm, and it will take us 10 bars. It says that the average swing will be 10 bars. Okay, so now you understand that. So if you have a correction, so you had an impulse and now you have a correction, and you know that the correction should be 396. So you projected your size to the downside. Sorry, let me use it this way. You projected your price as 396. It should go here, and you place your horizontal line here. Yes, 396, for example. And you also know that it should happen within the period of 10 bars. So you also calculate one. Let me make a different color. Let it be red as we go to the downside. 1, 2, 3, 4, 5, 6, 7, 9, 10. So you know the time when it will happen, and you know the price when the correction is most likely to end based on the market research. Do you see that? See the benefits? So you know when you will take your profits, or maybe you will cover your position, or maybe you will initiate your position based on this information. And the same with impulses. The same with impulses. With impulses we don't have time. Yes, we should turn that into the algorithm detects the correction, the average correction. It is based on the average correction size, ACS algorithm. Okay, when you know the average correction size, it tells you what how many bars that in this algorithm. And if we suppose that the number of bars here and here is the same, the impulse and corrections, if we suppose the markets are harmonic, then the number of bars in impulse and corrections are the same. Okay, so we have this time and the price projections. Knowing that, we have an advantage, we have an edge. Okay, wonderful. We also can stretch our Fibonacci. Let me show it here. Yes, so we have swing here, upside swing here. We stretch our Fibonacci, and if this projection coincides with 50%, we have an additional thing. Okay, and it will be very, very interesting to make this kind of Excel spreadsheets for every pair, and we will also know the average correction for the whole market, not only the pound Canadian but other markets. Maybe it will have the pattern between them, that the number of bars stays the same between all the pairs. Okay, now let's continue. So what is our second size? Is 582, 582.9, 582.9. So we go here, 582.9, and this will be our thing, and it says 20. Oh, 20. So we just doubled. It is 2 times greater, 20, if you use this algorithm. Then we go to, what is the number here? Is that 193.9. Oh, sorry, 693.9. 693.9. 693.9. So we use it. 693 and 9. This is the algorithm, and it gives 28. I don't quite see the pattern in time relation, but maybe we'll have some pattern here as well. Okay, 826.4. 826.4. 826.4. What if we use this algorithm? So we have 40 bars, 1.43, and then what if we use 9, 13, 9, 9, 13, and 9, and 9. So what is our algorithm here? Is 49 bars. 49 bars. Well, maybe we won't be able to draw the to make those strategies that are exactly precise and that have a positive expectancy based on that, but knowing these things about the market, we can do, let's say, a higher time frame analysis, yes, on daily, and we just suppose this is the picture on daily, yes, and we just come here, and based on our calculation the correction should terminate a bit deeper in 2 days, and starting from this we understand that we enter the so-called buying mode, and somewhere here we should start that buying pressure should begin, and on our lower time frames we will only look for, let's say, bullish patterns, bullish godlies, bullish ciphers, whatever, bullish crabs. So we'll only look for a bullish opportunity based on our high time frame analysis, and the high time frame analysis is based on our market research. And it is very simple analysis. It is simple price and time calculation, and we can calculate also minor swings. And just imagine if we do it this way. We analyze the market from a larger swing perspective, like this, yes, and the large swing should terminate here. And we also analyze the market from a smaller swing perspective, and it says that the smaller swing, a smaller impulse should terminate here within the period of this number of bars and this number of pips, yes. So we know the total, let me make it, we know the total number of correction of higher degree waves, swings, should terminate here, and we know that the impulse should also terminate somewhere here. And when the two coincide, we have no disadvantage for price to move higher. Well, this gives me very wonderful food for thinking. Okay, now let's continue. 146.1, 146.1, 4 hour, it should be 4 hour. We switch to 4 hour. 146.1. We just go here and we type 146.1, and it is this. The smallest algorithm, it tells me 10 bars. Okay, now it looks kind of suspicious. We have 10 bars here, we have 10 bars here. It looks kind of pattern looking, yes. So if we use that number of pips as a reversal, we have 10 bars here and we have 10 bars here. So I just project that we should have 20 bars here then if we use 2108, 2108, 2108. So it is 200 pips basically, and we have 19 bars. Okay, 19 bars, and the correlation is that between them is close to 2. Okay, 2609 is the next one. 2609, 20 should be 20. So what we have is 29 bars. 29 bars. Previously we had 28 bars. 29 bars. Okay, then 29, 31. 29, 31. If it is, what do we have that? So it is 38. 38. 40 and 38. Okay, guys, it looks like a pattern. So we should have 10 bars. We should have somewhere around 19 to 20 bars, 28 to 29 bars, 38 to 40. It looks like a pattern. Some combination. $33.1. If you go here to use that, 33.1. Sorry. Yes, 33, 31. Okay, done. 33, 31. So what we have is this 50 pips. 50. Okay, see, 49 here, 50 here. Okay, it looks like a pattern. Now let's switch to 1 hour and we should calculate 69.1. To 1 hour, 69.1, and it is this 10 pips. Oh, sorry, 10 bars. The average correction is 10 average impulse, average correction, average swing is 10 bars. I presuppose that average impulse and average correction have equal time duration. They have different price duration, but they have equal time. 97.1, and I anticipate that it is 20. 97.1, or somewhere around 20. 97.1, somewhere around 20. 19 maybe. 19. Okay. 11.79. 11.79. Pip reversal, and it should be somewhere around 28. Yes, it goes to 28 bars. Okay, 29, 10, 19, 29, 10, 19, 28. It is a pattern. It is obviously a pattern. It is something that is typical. We have some deviations, but statistically it is something that is typical. 1368. 1368. 1368. Okay. So let me type it. We have 39. 39 here, 38 here, and the last one should be around 50, 49 to 50. 1624. 1624. 1624. Okay, 50, 49 or 48. 50. 52. 52. Well, cool. Indeed, this is cool. We have 10, 19, 29, 38, 50. 10, 19, 28, 39, 52. Well, amazing, amazing. This is I don't know it yet. I simply have the ideas of how can I profit from that, but I don't have the thought out strategy based on this. But it can help to analyze the pound Canadian market at least. And maybe if we have this pattern confirmed by other pairs, maybe it can be the basis for analysis. So we know that this time should pass for a correction to end. We know that this price should move this distance for starting for some impulse or for starting for a correction. This is very interesting. I think that this kind of market research were done long before me. I'm not the only one to perform that kind of research, and my only innovation here is that I do it myself. I created the special indicator that calculates that, which is much more precise that you're calculating it manually. Just imagine that you calculate it manually, so you calculate the number of bars, 1, 2, 3, 4, 5, 6, 7, and blah blah blah, then you type it down, or you just measure it this way, the number of distance, then you measure the number of bars. Just imagine doing that work. It is kind of insane doing this. Okay, so 40.2, we switch to 30 minute and we go to 40.2. 40.2 should go here. 40 and 2. And we have this 10. Okay, 10. Well, then guess what will be the number if I type 57.7? It should be around 20. 19 will be okay. 19. Guess what will be the next number? 28 maybe. 71.9. 71.9. So the next number will be 29. Oh, you see, I'm anticipating already. Okay, 81.7. 81.7. 81.7. And it is 36. It is not 38, it is not 39, it is 36. We'll have some deviation from the average. 38, 39, 36. Maybe plus or minus 3 bars will be okay. We also should calculate the deviation, because when you do draw your time projections, you should understand that it should become plus or minus 3 bars or something of that kind, and you should calculate the deviation. Okay, then we go 89.9. 89.9. 89.9. And it is 43. 43 is much less than 52. It is much less than 50. It is much less than 49. Okay, obviously we'll have a deviation, which is pretty good. 7 to 9 candles. Okay, maybe it is accidental, or maybe it is a pattern that on 30 minutes we'll have that kind of deviation on all pairs, on all time frames. Okay, let us switch to 15 minute and let's start doing that. 27.4. We just go and type it, 27.4. So guys, guess what will be the number if you use 27.4 reversal factor? 27.4 pips as your reversal. Of course it will be 10 candles. 9. Well, yes. Missed one candle. 10 candles, 9 candles. Okay. 39.1. 39.1. 19.9. 19 candles. Okay, this 19 is kind of interesting. 19 here, 19 here, 19 here, 19 here, and 20. This one is very, very stable. 19 candles. Okay, then let's calculate it this way. What is this? Oh, sorry. What is the number? 47.4. 47.4. Okay, it gives me 27, 27, 29, 28, becomes smaller, 29, 27. 55.9 is the next one. 55.9. Okay, it is 36, goes here, 36. Then 64.6, 64.6. 64.6. Yes, it equals what? 47. 47, slightly less. It was 36 and it is 47. Oh yes, yes, 47 should be around 50. Yes, the last one. The one before them should be 38, 36, 36 here, 36 here, 39 here, 38 here. There is a pattern, guys. There is a pattern. I think we should collect more data to get more data to calculate that. The more data we have, the more reliable our statistical numbers. Okay, then let's switch to 5-minute time frame, and the first reversal is 14.4. The first factor is 14.4. And we'll have 9. It is obvious that we will have 9. Pretty predictable. And we will have 19 to 20 if we type 21.0. Yes. We'll have 28 to 29 if we type 25.9. 25.9. Okay. We'll have 37 to 38 if we type 29. 29.7. 29.7. (37 to 38). 37. Okay. And we will have somewhat around 50, maybe 98 to 99. Oh, sorry, 48 to 49. If we type 33.7. 33.7. Okay, so 48 to 49. 48. Okay, wonderful, wonderful. There is obviously a pattern.